Mastering risk parity. Boost portfolio diversification now. In today's fast-changing market, diversification is more crucial than ever. But are traditional investment strategies enough to protect your portfolio? Enter risk parity, a powerful approach to portfolio management that strikes the perfect balance between assets by focusing on risk contributions rather than just asset allocation. In this video, we'll explore how mastering risk parity can elevate your investment strategy, reduce portfolio volatility, and pave the way for consistent, long-term growth. Whether you're a seasoned investor or just starting out, this is your ultimate guide to unlocking the secrets of risk parity. Let's start with the basics. What is risk parity? Picture a traditional investment strategy, perhaps a 60/40 allocation between equities and bonds. Seems diversified, right? Well, it's likely not as balanced as you think. In a standard portfolio, equities often contribute the majority of the risk, leaving your portfolio overly exposed to market downturns. Risk parity flips the script. It's a strategy designed to equalize risk contributions of different asset classes within a portfolio. Instead of allocating capital based on dollar amounts, it prioritizes risk-adjusted allocations. This ensures that no single asset class disproportionately drives the portfolio's risk, creating a more stable foundation for your investments. Simply put, risk parity doesn't just spread investment dollars, it spreads risk, helping your portfolio withstand turbulence in any market condition. Many traditional portfolios are heavily reliant on equities, either knowingly or unknowingly. These portfolios often work well in bull markets where stocks perform strongly, but they're highly vulnerable during bouts of economic uncertainty and market volatility. Take, for example, the financial crisis of 2008 or the COVID-19 market shock of 2020. Portfolios weighted heavily towards stocks took huge losses, testing the nerves of even the most seasoned investors. Relying on a single asset class for the bulk of your returns can be risky. That's where risk parity steps in, offering a smarter alternative. At its core, risk parity optimizes your portfolio by focusing on risk distribution. Imagine a portfolio that includes stocks, bonds, and commodities. In a traditional framework, these asset classes might have vastly different levels of risk, leading to an imbalance. Risk parity adjusts allocations so that each asset contributes equally to the overall portfolio's risk. This can sometimes mean increasing exposure to safer, lower-risk assets like bonds by using leverage, while scaling down exposure to higher-risk assets like stocks. The result? A more balanced portfolio that's less dependent on any single market environment, giving you a smoother ride through economic ups and downs. So why should investors care about this strategy? Here are the key benefits. Reduced volatility. By balancing risk exposure across assets, your portfolio becomes less volatile and more resilient to sudden downturns. Reliable performance in any market. Risk parity portfolios perform well across various economic environments, from inflationary periods to recessions. Enhanced risk-adjusted returns. It's not just about how much you earn, it's about the risks you take to earn it. Risk parity maximizes your portfolio's efficiency on a risk-adjusted basis. Ultimately, it's about creating an investment strategy that doesn't just survive but thrives, even in volatile markets. One of the standout strengths of risk parity is how it handles market volatility. By diversifying risks instead of just capital, the portfolio is less tied to the performance of any single market. Stocks may crash, but bonds and commodities could rise, helping to cushion the blow. Consider this historical example. During the 2008 financial crisis, risk parity portfolios outperformed many traditional portfolios because their allocation to safer assets like bonds provided stability when stocks plummeted. This adaptability is crucial for investors who want protection against unforeseen market turbulence. Wondering if risk parity is right for you? The answer is almost everyone. For beginners, it's an excellent introduction to creating more stable, diversified portfolios. For experienced investors, it offers a sophisticated strategy to refine your approach. Whether you're aiming for steady returns or looking to safeguard against market shocks, risk parity provides a path to smarter, more consistent investment outcomes. Let's get practical. How can you implement this strategy? Here's a simple walkthrough. Assess asset classes. Identify a mix of assets for your portfolio, such as equities, bonds, and commodities. Determine risk levels. Measure the volatility of each asset to understand their individual risk contributions. Reallocate for risk balance. Shift allocations as needed to ensure each asset contributes equally to the total risk. Consider leverage. For lower-risk assets such as bonds, some portfolios may use leverage to align their risk with higher-risk assets. It's that straightforward. Focus on risk balance, not just capital allocation. One of the critical factors in risk parity is understanding the correlation between your assets. Correlation measures how closely assets move together. For example, stocks and bonds typically have low or negative correlation, which makes them ideal for risk parity portfolios. Balancing correlated and uncorrelated assets helps create a portfolio that behaves predictably, even in volatile markets. It ensures that as one asset declines, others within your portfolio may hold steady or even rise. Bonds play a crucial role in risk parity, often acting as a stabilizing force against the volatility of stocks. They tend to perform well during economic slowdowns and can offset losses in equity-heavy portfolios. By allocating appropriate risk to bonds, you're essentially building a buffer that protects your portfolio during challenging times. Including commodities in a risk parity portfolio adds another layer of protection. Commodities like gold, oil, and agricultural products behave differently during economic cycles. For instance, gold may rise during periods of inflation or geopolitical instability, providing a hedge against falling equity markets. This diversification ensures that your portfolio stays balanced across all economic environments. Managing a risk parity portfolio doesn't have to be complicated. Various tools and software are available to help investors calculate risk contributions and design balanced portfolios. Platforms like risk management calculators and portfolio simulators can simplify the implementation process. These tools allow you to assess your current portfolio and adjust allocations to achieve a risk-balanced structure. How do you know if your risk parity portfolio is performing well? Key metrics include: Sharpe ratio, measures risk-adjusted returns. Volatility, tracks the portfolio's overall price fluctuations. Drawdown analysis, gauges the severity of portfolio losses during downturns. A successful risk parity portfolio will demonstrate consistent performance across these metrics, signaling that it's achieving its intended purpose. Risk parity isn't without its hurdles. Some investors may find the cost of implementing this strategy prohibitive, particularly due to leverage or access to certain asset classes. However, many of these challenges can be addressed. For retail investors, exchange-traded funds, ETFs, and mutual funds dedicated to risk parity are accessible alternatives. These funds are professionally managed, making them simple entry points into the world of risk parity. Risk parity shines because it adapts to various economic environments, including inflationary periods. Commodities and inflation-protected bonds balance risk. Deflationary periods. Treasuries often stabilize portfolios. Growth periods. Equities contribute to higher returns. Recessions, bonds act as a safety net. This versatility makes risk parity uniquely suited to navigate unpredictable markets. How does risk parity stack up against popular strategies like the 60/40ths portfolio? While 60/40ths focuses on a fixed equity-to-bond ratio, risk parity prioritizes equalizing risk impact. This distinction often leads to better performance during economic upheavals or market crashes. Unlike market timing, which tries to predict when the markets will rise or fall, risk parity is a long-term strategy. It doesn't rely on speculative moves, but instead focuses on maintaining balance, making it more sustainable and less stressful for investors. Leverage is often used in risk parity to scale up lower-risk assets like bonds. For example, if bonds don't carry enough risk, leverage can increase their impact so that they align with higher-risk assets like stocks. While leverage can amplify returns, it's essential to use it carefully to avoid overexposure. Imagine a portfolio with these allocations. Stocks, 30%. Bonds, 50%, with leverage applied to match stock risk. Commodities, 20%. This allocation ensures that each asset contributes equally to portfolio risk, creating a balanced investment strategy. Risk parity doesn't follow a one-size-fits-all model. Your risk tolerance, financial goals, and investment horizon all play a role in determining allocations. A younger investor might allocate more toward equities, while a retiree might emphasize bonds and safe haven assets. Large institutional investors like pension funds have successfully implemented risk parity, to protect and grow their clients' wealth. Additionally, prominent hedge funds have proven risk parity's effectiveness in weathering market storms. As markets evolve, so does the need for adaptable strategies like risk parity. Its popularity is likely to grow as more investors seek stress-free, diversified approaches to wealth building. The ability to balance risk across different economic regimes aligns with today's uncertain world. So, what's stopping you from implementing risk parity in your portfolio? Now is the time to examine your current asset allocation and consider how risk parity could transform your investment strategy. Start with small steps or consult with a financial professional to get started. Risk parity isn't just a strategy. It's a mindset that prioritizes balance, resilience, and smart risk management. By mastering risk parity, you're taking a proactive step toward building a portfolio that withstands the unexpected while delivering steady long-term growth. It's time to embrace risk parity and unlock the full potential of your investments.